Okay, so what I really want to talk about is what's fueling the bull market, and I want to be really clear. This is it. Now, the truth is, everyone's like, this is what my opinion is, and this is what is not moving. This is what does not move the bull market. This is what does not affect the market whatsoever. And it's really important that we can come to that point of understanding what is moving and what is not moving the market. Once you're able to take those biases away, I think you're able to make money in the market, and it becomes a little bit more simple. And that's why I kind of want to do these videos, because it's easier for me to break down my train of thought, fundamentals, and things along those lines with the market as well. So that's what we're attacking today. Now, this past week we had the Fed meeting, and we kind of had a lot of expectations. We also had CPI and PPI, which inflation continues on the downtrack. And not my words, the Fed's words, they were completely and utterly shocked by the reading. Again, that was their words, not Tyler. Now, moving on from that, it's important to understand what the Fed said there. They still kept expectations pretty conservative. Again, the Fed's words, not my words. But if data continues to come out like this, it could definitely shake things up and make things a lot more interesting. So when we go back into what the Fed is saying and what they're doing, it's important that we keep that in mind. Now we go into what overall has been and what is being said. This is the biggest part here, okay? So they did price in one cut, and that's it, and that's not good. Right? The fact that this Fed has scaled back the number of rate cuts from 3, they were at 3, now they're at 1, is going to disappoint. And I will say, initially, when you look at markets, it did. You can even look at something like yields, and we saw that immediately here. And I'm going to talk a lot today about yields and what's happening. But again, you saw yields skyrocket. You know, they jumped from initially from 4.4 over that the night before into just basically just up. So worth mentioning, yields did start moving, and then going into Wednesday as well. This is the beginning of the week, and then obviously Wednesday when that happened, you jump up and then you kind of start dropping back down. But we're going to talk exactly why. Again, the drop here in yields is all due back into what's happening with the Fed and what the Fed has been saying and what's happening with inflation reports as well. Because despite maybe that, and it was a bearish viewpoint, right? Only expecting one cut. I will be totally honest about that. The market didn't care. In my opinion, the market's listening more to what I have been trying to push, right? Is that the Fed has said there's a few things that have to happen for rate cuts to happen, right? We can, and the Fed has said this as well. They can throw projections out, but ultimately it comes back down to data. And the Fed has said, we go into this, is that if the data continues like this, you have to be bullish. You have to be, right? Because again, that's where we were. He did say that all expectations were given before CPI came out, and nobody chose to rearrange or change their viewpoint on the dot plot. So no one came back and changed their opinion. Although you do have that opportunity, they chose not to, okay? So that's very important to understand. So the dot plot is something that we should be viewing and watching. But despite the dot plot and what kind of happened there, we look at the 10-year Treasury, and again, still on the decline. Very important. Also, another major bullet point here too is, again, I understand, and I want to side that I think that the one rate cut expectation is like not good for business. Business not booming based on that. But what does the market say? Again, let's go to the 30-year fixed mortgage, right? And I want to show you something very quickly. Like when we look at the fixed mortgage, it's very important that we're able to identify what the overall trend here is, right? This is the 30-year yield. It's probably the best. I think it's the best metric to view inflation in general. I think it's amazing. Okay, so you look at highs back here, October, November 2023. Obviously, you dip down basically into December, and then you going back into April of this past year. This year right now, you kind of saw the rise back and what happened here, and now you're dropping back down. It looks like a cycle to me. Just saying. Well, let's go look at what happened with 30-year fixed mortgages, right? During that major decline from October on the yields down to basically December, 30-year fixed mortgages went from 8% all the way down to lows of 6.6. During the rise that we just had back into April, they went back up to 7.5. Now they're dropping back down to 7. So there's a high percent chance that we see yields and we see mortgage rates continue to drop throughout summer, especially if data continues in this trend, especially if the yields start breaking down below. Now, where do things get really crazy? Like, where does the icing, where is it beautiful? It's when we get back below the 4% level here. And I don't want to spend a lot of time on this channel on my charts, but it's important that we understand fundamentals of what's happening here. When the market got the most bullish was when we were below 4% on the 30-year fix. So it's important that we understand that. And if we see the housing market start to pick up, I promise you there's one constant in the stock market. When the housing market's doing well, overall, the market does well. When we look at when the market started spiking, the housing market specifically, November, December, we saw housing sales go up again, right? People wanted to refinance, get back into the market. Guess what happened, people? Again, you started seeing the money flow back into there, right? You started seeing the market go crazy from November into basically January. It was absurd what we were really seeing take place during that point in time. Again, we can go back and look at the chart here too. You know, when you look, there was never really a decline. If we look at the 30-year fixed mortgage from 2022, even when the market had a bottom, right? Mortgages are still going up into 2023. Very important to understand that. Until last year, they found a top near 8%, which was kind of absurd to think about, right? And then we obviously started declining here beginning of the year, right? And it was a steep decline. That's very important to understand, right? Now, I want to paint a picture for you so you can understand. There's going to be a difference when this next round of mortgage rates drop. Because not only are you dropping based on the price of bonds and yields, you're also going to be dropping based on the effects of if the bond market, the yield market are in favor of the market, the housing market, right? It's going to do a few things. One, it's going to weaken the inflation of shelter prices, which is one sticky area the Fed continues to explain, right? So the point is, again, we talked about this in the last video, it's the only area of inflation we did not expect to be budged at all, which it wasn't. But the areas of inflation we talked about, energy specifically, were destroyed. We saw energy get crushed. Energy inflation was way, way, way down, and it made logical sense based on the barrel, whatever was happening between the barrel prices, energy, etc. Right? So shelter. As we see mortgage rates drop, shelter prices will also drop. The last time we saw shelter prices drop were again around November and December when mortgage rates were dropping. The only way to get rent prices down is to have the equal demand or some demand come back into the housing market where people can start actually getting from a place of renting to a place of buying, right? Because as long as demand stays very high for rents and people can charge out of the wazoo for those rents, guess what, guys? The price is never going to go down. If I am selling, flip phones for a living and I'm selling them for $100, well above what they're worth, but every single day I sell out, right? Why on earth would I lower the price of my flip phones? It makes no sense. Now, if I start to only sell 50 and I sell 50 left over, I might start doing some specials. That's the way supply and demand works. It's like we forget that this applies to everything and not just maybe a good that we're buying, but also homes. Also, what's happening with rents. That's why home prices still aren't dropping. Because even though mortgage rates are making it more difficult to buy a house, guess what? More and more people want to buy said house. And people are still buying houses at high rates. It's just not the same volume and quantity that we were seeing back in 2020, 2021, even a little bit in 2022. So those are very important factors of what we're looking at here. And I promise that's the next step of inflation that starts to really bring shelter down. And once shelter comes down, I think that's when the Fed looks really good. Now, the next point we want to look at is unemployment. And again, we talked about this. The unemployment rate came out this week, and it was nothing short of great. So we look again what happened here. The unemployment rate came out at 4%. Amazing, right? Now, the question mark here we talked about as well was non-farm payrolls. So non-farm payrolls showed more activity in people getting jobs, and then the unemployment rate showed less activity in people filing for unemployment, obviously. Now, the Fed was very clear about this. You cannot judge unemployment on one statistic. So if non-farm payroll is showing that people are getting more jobs or there's more job openings, this or that, right? Then you can't really focus on that. But if unemployment is going up, then the unemployment is going to waver more on the market. It's going to show, maybe there's people getting part-time jobs. And there's a lot of skewed opinions on what's happening with non-farm payrolls. And I don't want to jump down the conspiracy train, but it's important to understand we need to look at all metrics, not just one. Just like when I look at inflation, I don't look at just CPI. I look at PPI, I look at PCE. I even look at their super core inflation. That's the Fed's favorite thing to talk about, which again, they didn't talk about at this Fed meeting, super core inflation. I don't even want to bring that into the video, but again, it was on the decline. You can Google it for yourself. It was there. Information is at your fingertips. Another major area was wholesale prices dropping in May, adding more evidence of what's happening here. You even saw from various CEOs with more earnings coming out that consumers, it's harder to keep prices high on consumers because they're picking and choosing where they're spending. Now, everyone wants to say, guys, groceries are expensive, and I agree. I agree. Groceries are expensive. I pay the credit card off every month just like you, right? My wife goes, she buys the groceries, and I'm like, okay, this is cool. We're spending more and more. But you need to understand, One area of the market is not equivalent to all areas of the market. Very important to understand. And also, too, you're going to have a healthy amount of inflation over time. The question is inflation continuing to rise? Are we stagnating? Is it slowly going down? And there's some areas where inflation is going to stick no matter what. Like home prices, as much as people think the real estate market is going to crash, it's not going to crash. Inflation should stick and will stick when it goes into home prices and values there. If you didn't get your house, I'm sorry. There's always the next 20 years. Maybe not. I don't know. But going into what's happening with, again, wholesale prices, this is another big area specifically for you and me, the consumer, of, again, inflation cooling, a very beneficial part here as well. Okay, so we look at the broad market. What's happening? CPI, PPI, PCE continue to drop. They just are. The Fed does not want to push a narrative, especially Powell, that they are going to cut rates soon. They don't want to push a narrative that they're going to cut rates. They don't want to push a narrative that they're going to raise. They've said they're not going to raise rates, so that's just important to understand. But they don't want to push either agenda too much. They want to stay in the middle ground so they can do whatever they want to do, and they can't be accused of lying or misleading, which makes logical sense because Powell's done this for the past 2 years, and I will say he hasn't really lied or done anything wrong. My personal opinion. So again, we look at what's happening and he's staying in that middle ground, but he has told you the clear-cut path. If unemployment continues to rise, if inflation continues to drop, they will cut rates. Now, the million-dollar question is, if inflation is moving in the right direction and the economy is healthy, why would they cut rates? And I agree. To a certain extent, I agree. 100%. But you have to understand, if you, just like they, in my opinion, they raised rates a little too slow. They should have done them a little bit earlier in 2021. They waited. That's their own fault. And it was bad time with oil prices and what happened with Ukraine and Russia. It's a perfect storm. If they wait too long to cut rates, the consumer can get into a very sticky area, or the market can get into a very sticky area. This is happening. Honestly, the market's recovering in the best way possible. Now, I'm not saying that long term this will not create issues or stress on the overall market, or what happens when, either Trump comes in or Biden comes back in office, whatever it may be. But in the short term, it's important that we're understanding that. This is a weekly video. It's maybe 2 times a week video I'll make here. In the short term, you continue to look fantastic. And I'm telling you, the strength in the market should not weaken until data says otherwise. Until PCE, PPI, CPI come in with stagnant inflation again, or rising inflation. There's no reason for weakness. I'm telling you right now. We look at overall stocks. We look at Apple Intelligence. We look at what they're doing with AI. We look at the growth across the board in most tech companies. There's no reason for weakness. And for people to say, oh, well, the market's growing, we don't need to cut rates. Well, obviously, Apple growing is different from you, the consumer, weakening. It's different. There is a different level to all this as well. So as I look at the market, I remain bullish. I look at the market from that viewpoint, and I look at it from an unbiased viewpoint. I'm not net long on my whole account, full sending it to the moon, but I'm very happy with how we're moving and the overall data that's coming out. The S&P looks fine. The Dow is the only area of the market I think that needs a little bit of love, but I do think with another set of good data from CPI, PPI, PCE, inflation, or just core inflation in general, I think IWM, the Russell, mid caps, small caps might start finding their legs, because once those small caps start finding their legs like they did in the beginning of the year, we'll start just seeing explosions across the board, just like we did back then. And again, this is where you make your money, right? When you start getting a clear-cut trend, great data, and you're just moving in a clear direction, that's where you make your money. Now, that doesn't mean you lever or you go all in, but you are vigilant and you're paying attention to what they're saying, right? Because at the end of the day, it's not about what we want the market to do. I mean, I have whatever, I want the market to go straight up for 20,000 points. That'd be awesome. At the end of the day, it's about what the market's telling us and what the Fed is telling us to expect. Because if you get what the Fed expects and what they want, obviously it's easy to trade from that viewpoint. That's my opinion. If you have comments, comment down below. See you guys next time. Follow for more content.